Hi everyone. So welcome to the live stream today. Very much excited for having you joining us on the next discussion that we have. I see some of you joining the stream. Welcome to the stream. Today we're looking at something relating to financial management as well as management accounting, focusing on one of the fundamental topics, which is investment appraisal. And we're going to be solving a question on net present value and find out how we can calculate the net present value of a project or an undertaking. So welcome to the live stream. It's always a pleasure. I see some of you guys joining. Give us a thumbs up on the video when you join the stream. That way we get more engagement on the video, and YouTube and Facebook will be able to push the video so we can reach as many students as possible. So smash the like button if you have not done that. Then consider to also share the video with your friends, colleagues, and also people who you know will be interested in lectures like this so we can reach as many students as possible. Now, the question we want to solve today has been posted already on my Instagram page. So in case you are looking for the question, I'm going to be sharing my screen with you though. But in case you are looking for the question, it's going to be on my Instagram page. And you can also follow me on Instagram at Nhyira Premium if you're not following me there, because the details for our meeting and questions to be solved will all be posted on the Instagram page. So welcome to the stream. Title, Siami, I see you. You are welcome. Quebec Festus said, or Quebec Festus said, good evening from Pearl of Africa, Uganda. All right. Welcome to the stream, Festus. Titus Siami said, thanks, you are welcome. Right, so welcome to the stream. I see some of you guys jumping up on the stream. Welcome. When you join, just smash the like button and let's get the YouTube algorithm kicking in and getting more conversation coming in for us. Comment also in the chat box any questions that you have for me. We want to discuss something that is very critical today. If you are writing financial management and management accounting, that is F2, and then dealing with the issue in relation to F9 in ACCA, then in ICA dealing with financial management, management accounting. These are critical areas. This is a critical topic that you need to understand in relation to that. So questions have been posted on the channel already, my YouTube page already. Penelope Pius said, well done, said, thank you, Penelope Pius. Welcome to the live stream. It's always a pleasure coming your way. And I see some of you guys also joining. Welcome to the live stream. I see Edwin Balansua. Sorry if I don't mention your name right. Said, bless you. Bless you to Edwin. Esther Akosa said, hi, said, okay, then with an emoji. Hello, Esther. Welcome to the live stream. So there are a couple of you who have been asking, Nhyira, when are you doing something in financial management? We're going to be covering some issues in financial management, specifically from next week, God willing. But we're going to be starting that with an investment appraisal question today, NPV. So let's go straight up into our question for today. Let's go straight up into it. Let me share my screen with you. Then we go straight into our question for the day. All right. So, question has been posted already on my Instagram page. So, you can get a copy of the question on my Instagram page and be able to follow along as you prepare for the exam. But I'm going to also be sharing my screen with you. So, we're actually going to be doing it together in that case. So, let's go to the requirement of the question real quick and find out what we are supposed to do. So, for 14 marks, the examiner is asking us, assess the financial desirability of this venture in real terms. In real terms, computing the net present value offered by the project. Now, when it comes to investment appraisal and analyzing or appraising projects using the net present value, two things must be in your mind: that cash flows can be in real terms and cash flows can also be in nominal term. I think I'm sharing a Word page. Let me share the PDF version instead. Okay. Right, so when it comes to dealing with the issue in relation to investment appraisal, there are two things you need to understand. Cash flows can be in real terms, cash flows can be in nominal terms. When we say cash flows are in real terms, it means today's cash flows. It means cash flows in today's term. What it means is that it does not include any, how do we call it, inflation. It means there is no inflation in it, but they are in today's term, they are in real terms. So the examiner is asking us that we should calculate the cash flows in real term for the question under discussion today. So in today's term. Now, if cash flows are in real terms, then the discount rate we need to use has to also be the real discount rate. It's got to be very important here. If cash flows are in real terms, then the discount factor must also be in what? Real terms, okay? So, because it can be the two. If cash flows are in nominal terms, then we have to discount using the nominal rate for the organization. So the most important thing is that we are calculating the net present value of the project in real terms, meaning in today's term, excluding inflation. So if that is what the examiner is asking us, let's go up and then let's build up our understanding on this particular question. So let's see. Mawena Limited, a manufacturer of building materials, has recently suffered falling demand due to economic crisis and thus has unutilized capacity. Management has identified an opportunity to produce designer ceramic tiles for the home improvement market. It has already paid 1.5 million. Listen carefully. It has already paid 1.5 million Ghana cedis for development expenditure, market research, and feasibility study. Now, the first question you need to ask yourself is, this $1 million that had already been paid, in making our analysis in the net present value, is that a relevant cash flow? The answer is no. It is not going to be a relevant cash flow. So this $1.5 million is a sunk cost. So since it has already been incurred in the past, it means that we are not going to factor it into our discussion. I hope it makes sense. So any cost that has been incurred in the past will not be taken into consideration when we are making our NPV decision or calculating the NPV of the project. So that is something that is very critical that you need to understand in relation to that. So that 1.5 is a sunk cost, is an irrelevant cost, and we are not going to consider that in the making of our decision. Then we move on. The new machine with a useful life of 4 years could be bought at $6.5 million. Okay, so this is a relevant cash flow, and the cost of that is what? $6.5 million, payable immediately. So now in MPV, now means zero. So under year zero, today's term, right now, we're going to be paying what? That money, $6,500. The scrap value of the machine is expected to be 5% of the recoverable, of the cost recoverable a year after the end of the project. Be careful here. It didn't say the thing will be recoverable at the end of the project. Instead, it says a year after the end of the project. You got to be careful there. So let's get 5% of 6.5. So 6,500 by 5%. That's 325. So listen to this carefully. So the scrap value or the residual value of the asset is 325. We are working thousands, right? Now, it will be received a year after the end of the project. Remember, the project has 4 years. So if it will be received a year after the end of the project, that means this 325 will be received in year 5, okay, or in the 5th period. I hope you are getting the treatment. So this scrap value will not come under year 4 because they didn't say at the end of the project. They said at 1 year or a year after the end of the project. So that is going to go in period 5 on our MPV Shadow. Let's see. The Research and Development Division has prepared the following demand forecast. Okay, so the examiner has given us the units that are going to be sold respectively in the years under consideration. Year 1, 110, year 2, 130, year 3, 150, and year 4, 145,000 units. So let's build it up. The forecast, the selling price is $10 per box in today's price. Estimated cost, largely based on experience, are as follows. So we see in today's term, remember, it's very important you understand that the examiner said we should calculate the NPV in real terms, which means the cash flows must be in today's term. In today's term. So we see material cost $12, direct labor cost $5, variable overheads 2.5, fixed overheads allocated 3.5, and then distribution, which is variable, 5.5. Now you got to be careful here. Another thing you must understand is that when it comes to NPV or investment appraisal, fixed overheads allocation or absorption of fixed overheads is an irrelevant cash flow. In other words, if we want to determine the cost per box of tile, the fixed overheads allocated will not be included. Why? Because that is an irrelevant cash flow. It will be incurred whether we buy this asset or we do not buy this asset. I hope it makes sense. So if we want the cost per box, based on what we have now, it is going to be the $12 plus 5 making 17, plus 2.5 making 19.5, plus 5.5 making 5.5, that would be 25. So now our cost per box is $25. 25 Ghana cedis. Forgive me about the currency, 25 Ghana cedis. I hope you are getting the principle so far. So that is our variable cost per box. Variable cost per box. Remember that in NPV Shadow, we only consider the specific fixed cost, which is certainly the cost of the machine, 6.5 million Ghana cedis. It is only the specific fixed cost that we consider, but the absorbed fixed costs aren't considered in the making of this decision. So we have our variable cost per unit to be 25 Ghana cedis in that case, or per box, okay? I see some of you guys joining. Welcome to the live stream. We're looking at a question relating to investment appraisal. Consider to give us a thumbs up on the video when you join. That way we get more engagement on the video, and YouTube will be able to push the video so we can reach as many students as possible. So smash the like button if you have not done that. It helps us a lot to grow the channel together. And also comment in the chat box. Let me know any questions you have for me, or if there is any explanation I made that you don't understand, just comment in the chat box and I could retake that again for you. Then you can also consider to share the video with others so we can reach as many students as possible. Thank you very much. I see some of you smashing the like button on YouTube. Thank you very much. Thank you very much. So let's move ahead. In addition to the initial cost of the machine, investment in working capital of 0.2 million will be required in year 2. So when it comes to our schedule also, we are going to be bringing the issue in relation to what? Working capital. But note this. When it comes to NPV schedule, any working capital outflow comes as an inflow at the end of the project. Let's take that again. When it comes to dealing with NPV, net present value, any working capital outflow will come as an inflow at the end of the project. So this 0.2 million Ghana cedis, which is in year 2, will come as it will be an outflow in year 2, but in year 4, which is at the end of the project, that will come in there as what? An inflow. I hope you are getting the idea there. So that is the thing you need to understand when we talk about the issue in relation to the working capital. So that 200,000 will be an outflow in year 2, but will come as an inflow in year 4. Why? Because all working capital outflow comes as an inflow at the end of the project, because they are recovered at the end of the project. All right, let's go. Mawina Limited pays tax 1 year in arrears. Remember, the way you prepare your MPV schedule is based on how the entity is paying tax. They can pay the tax as and when the cash flow rises, meaning they will pay the tax in the same year, or they can pay the tax in arrears. If they pay the tax as and when cash flow rise, that means that we are going to pay the tax in the year. So year 1 tax will be paid in year 1, year 2 tax will be paid in year 2, year 3 tax will be paid in year 3, and it follows in that order. But if they are paying tax 1 year in arrears, meaning year 1 tax will be payable in year 2, year 2 will be payable in year 3, and it follows in that order. So in this question, we are told that Mawina Limited pays the taxes 1 year in arrears. So if they pay the taxes 1 year in arrears, what then do we do? It means that even though the life of the project is 4 years, we are going to prepare the schedule for 5 years. Does it make sense? Even though the life of the project is 4 years, we are going to prepare our schedule for 5 years, so that we can take into consideration what? The 1 year in arrears thing. All right. At an annual rate of 30%, that is good, on returns from the project. Okay. Mawina Limited shareholders required a nominal return of 14% per annum after tax. You got to be careful here. The examiner said we should calculate the NPV of the project in real terms. But then he has given us a nominal required rate of return, or a nominal cost of capital. What it then means is that we need to be able to change the nominal rate of return into what? The real rate of return. How do you do that? We use the Fisher formula. I hope you are getting the idea. So you are calculating NPV in real term, but the examiner has given us the nominal cost of capital. So we have to move from the nominal cost of capital to the real cost of capital. How do we do that? We do that by using the Fisher formula. I hope you get the idea. Now, we are told that the nominal rate is 14% per annum after tax, which includes allowance for general expected inflation of 5.5 or 5.55%. So there is an inflation rate of 5.55% per annum. The good news here is that the examiner said we should ignore capital allowance. You know, always NPV, we will be taking into consideration the capital allowance. But in this question, the examiner said we should ignore it. So it is like, oh, say, yay, we will praise ourselves for that, or we'll praise the examiner literally for that, because he said we shouldn't do that, all right? He said we shouldn't do that. Okay, so we've gone through it. We've seen that our cost per box is $25 or 25 Ghana cedis. We've seen the units respectively we're going to be selling. So let's do some workings real quick. So let's see. We're going to have the entity coming up. So Mawina Limited. Coming up like that. So let's do the workings first, as I've mentioned. The first workings we would want to do The first workings we will want to do is to look at the issue in relation to the real cost of capital. We could do that, but let's look at the sales first. So let's do workings for the sales. So we're going to have here, and that's going to be 1, 2, 3, 4. So let's bring the units that we're going to be having. And our units respectively are 110, 130, 150, 145. 110, 130, 150, 145. Note, we are working with 3 zeros up, or we are working in thousands, all right? Then we'll bring the selling price per unit. So if we check what is our selling price per unit, we were told in the question that the selling price per unit is 50. And remember, it is in real term, no inflation will be brought here. So by 50, by 50, by 50. So we multiply that up respectively to get our sales figure. So 110 by 50, I'm getting 5,500. 130 by 50, I'm getting 6,500. 150 by 50, I'm getting 7,500. Then 145 by 50, I'm getting 7250. All right, 7250. So these are the sales respectively. Then we look at the variable cost. So that will be workings 2, and that will be variable cost. The variable cost will have the same thing. So we have here 1, 2, 3, 4. We bring in the units 110, 150, no, 130 first before 150, 130, then we have 150, and then 145. Then remember we calculated the variable cost per unit above. So we're going to bring that up. Variable cost per unit. We calculated it as 25. So let's bring that up. So VC per unit. So that'll be 25, and it will run through. Because we are working with real cash flows. So let's multiply up that respectively. 110 by 25. I'm getting 2750. 130 by 25. I'm getting 3250. 150 by 25. I'm getting 3750. And then 145 by 25. I'm getting 3625. 3625. So that is also our variable cost. So we have the sales workings 1, we have the variable cost workings 2. Then let's do the third workings, and that is, you know, in this question, working capital, the examiner said we should ignore working capital. So since we should ignore working capital, or since the examiner said we should ignore working capital, it means we won't put it into the question and we won't work it out. But let's calculate the real cost of capital. Okay? So we need to calculate the real cost of capital. Or if you want, the real rate of return by the shareholders. And remember what we said, we're going to be using the Fisher formula, which is 1 plus M, okay, equals 1 plus R multiplied by 1 plus I. So that is our Fisher formula. Now, the M is the money rate, the R is the real rate, and the I is the inflation. Okay? So that is how it is. Now, we've been given the money rate or the nominal rate as what? 14%, and the inflation is 5.55%. So we will substitute that into it. So that's going to be 1 plus 0.14 bracket close equals 1 plus the real rate, which is what we are looking for, multiplied by 1 plus the rate of inflation, which is 0.0555. Okay? So you do the arithmetic and you make R the subject. So when you make R the subject, R will be equal to, let's see what we're going to have about that. So that's going to be, I'm not going to go through the change of subject thing. I know you know these already, so I will not do any change of subject, but you know this will come and divide this up. So that's going to be 1.14 over 1.0555 minus 1, and I'm getting 8%. So you can confirm that. So my real rate that we're going to be using to discount the cash flow will be 8%. I hope it makes sense. Like I said, I'm not doing the KG2 change of subjects. You know how to do it. If it is multiplying, you go and divide, and then you'll be able to get the answer there. This one, you did it in KG2, so I know you know. Okay, so that is our workings 3. Okay, so we did the workings 1 for the sales figures respectively, workings 2 for the variable cost, and then now workings 3 to be able to calculate the real cost of capital, and we are using the Fisher formula, and that is always what you use in relation to that. So now that we have all our workings, let's now do our NPV schedule and put all the pieces together on our schedule. Okay, let's put all the pieces together on our schedule. So should we label? Maybe let's label. So net present value. So NPV Shadow. Now remember, we are working 3 zeros up. So we're going to work in thousands like that. So we're going to pull the year up. And 1, 2, 3, 4, and then 5. Now, why are we doing 5 periods? We are doing 5 periods because of what? Because the organization is paying taxes 1 year in arrears. Okay? The organization is paying taxes 1 year in arrears. I'm seeing a comment from Pius Ajiman. He said, please, sir, did the question ask us to ignore capital allowance or working capital? It says capital allowance. That is what they said we should ignore. You can see that circled here. Ignore capital allowance. Ignore capital allowance. So it is the capital allowance we are ignoring. So now that we have our schedule put up, let's bring in our figures that we computed. So the first thing will be our sales. So let's bring in the sales. And that's from workings 1. So workings 1 there. So we go up there, pick our figures up. That is 5,500, 6,500, 7,500, and then 7,250. So let's put it down. So 5,500, 6,500, 7,500, and then 7,250. 7,2. Give me a moment. Okay, so let's go. 7250. So that's our sales. So we bring in the variable cost from workings 2, and let's go up, pick it up. That is 2750, 3250, 3750, and then 3625. So let's see. 2750, 3250, 3750, and then 3625. So we have the sales, we bring the variable cost, and when we subtract that, we're going to get our contribution. Okay, so we less that to get our contribution. Let's see what we get. So 5,500 minus 2750. I'm getting 2750 there. Remember, there is no fixed cost here, so 2750. 6,500 minus 3250. That's going to be 3250. More or less like the figures are going to be shared by two like that. So 3250. Then, so the third one, it's going to be 3750 and then 3625. Now, the reason why this solution is sinking through like that is because the selling price is $50 and the variable cost is, how do we call it? $25. So it's like half. So now we have our contribution. Then we will build in our tax. Okay, so let's bring in our tax. So income tax. So tax is at a rate of 30%. And remember, the tax is paid 1 year in arrears. So year 1, there will not be any tax, but the year 1's tax will be paid in year 2. So let's get 30%, 0.3 by 2750. That will be 825. Remember, that is going to be less, certainly. Then 0.3 by 3250. That will be 975. So you take that out as well. And then 0.3 by 3750. That will be 1125. Then year 4's tax will be paid in year 5. That will be 3625. And that's approximately 1088. We're working to the nearest 1,000. Okay, so these are our income tax respectively. Now, do we have any other cash flow in the question? Yes, we're having working capital. So we can bring in the working capital. So I'm going to just do WC here, signifying working capital. So WC, working capital. Now remember, we were told that, let's go back to the question where the working capital was, and then let's pick it up. We are told that in addition to the initial cost of the machinery, investment in working capital of 0.2 million Ghana cedis will be required in year 2. Okay, so in year 2. So the working capital, 200,000, will be required in year 2. Now remember, I told you that will be an outflow at the time it is required, but it will come as an inflow at the end of the project, which is year 4. an inflow at the end of the project. Then after that, there is also scrap value. So SV, the scrap value. Remember, we were told that, let's go back to where the scrap value was and let's pick it up. We were told that, where was that? Okay. So remember, we were told that the scrap value, let me delete some of these things here or wipe them up. So the scrap value is 5%, and we calculated that to be 325 here already. So let's go and put it there. And where it will be received is what I'm interested in. We were told it will be recoverable a year after the end of the project. A year after the end of the project. A year after the end of the project. So the scrap value will be brought in year 5, not at the end of the project. If they had said at the end of the project, we would have brought it to year 4, but they said a year after the end of the project. So it will go to year 5, 325. I hope it makes sense. Now I see a comment coming in. Henry is saying, sir, please, why is the working capital not recouped in year 5 instead? Year 5 is not the end of the project. Year 5 is coming in because of the tax issue. The end of the project is year 4. So that is the end of the project. That is why the 200,000 will come in year 4 and not in year 5. So Henry, that is the meaning of that. Let me know if you get the explanation now. So once we are done with all that, we add it up to get a net cash flows. I'm not supposed to close this yet because we will bring in the discount factor. So let's get a net cash flows, or sometimes we call it the free cash flows. Okay, the free cash flows. So if you look at it, we add it up. I think year 1 will still be 2750. Let's do for year 2. That will be 3250 minus 825 minus 200. And I'm getting 2225. 2225. All right. Then 3750 minus 975. I'm getting 2775. $2775. Henry, if you are still watching, I hope you understand the explanation I gave you. So 2775, then let's go to year 4. In that case, that will be 3625 minus 1125 plus 200, and I'm getting 2700. And then the last one will be the year 5, which is 1088 plus, no, that will be minus 1088 plus 325. And that will be minus 763. So 763. And that'll be minus, that'll be negated. So these are our free cash flows, So once we have the free cash flows, what do? We bring the discount factor, okay? And we calculated the discount factor to be 8%. So we bring in the discount factor and we read it on the table. If not, because this is management accounting, okay, the examiner will still give you the table, so you will read it on the table in relation to that. You read it on the table in relation to that. So 8% of that. So 8% of that, year one, per my thing, it should be 0.926. I know you know how to read, so I'm not going to be reading that on air here. 0.926. You just go to the present value table, go to 9%, and you start reading. So 0.926. Year two is 0.857. Year three is 0.794. Year four is 0.735. And then year five is 0.681. So you're going to multiply that up to get our NPVs respectively. So that will be present value. So let's see, 2750 by 0.926. I'm getting 2547. So 2547. Year two, 1907. Year three, 22. $2203, and then 1985, and the last one will be 519. That's negative. Okay, so that is our present value. Are we done? No, we aren't done yet. I see some questions coming in. Lila Adams said, thanks for doing this. You are welcome. Who else do we have there? Henry said, yes, I got it. Thank you. You're welcome. Lila said, we have a book value and a tax value. Tax is recoup, right? I don't understand your question, Lila Adams. You can look at that. Please do extrapolation and interpolation. Basically, you are discounting it back to MPV. Discounting what's back to MPV, you can clarify that. And the cost percent is always 1, right? I don't understand your statements, Lila Adams, so maybe you can clarify it. Pius said, please say, what is the weighted average or average cost of capital in MPV? In MPV, we don't, whatever cost of capital is given to us, that's what we're going to use. The examiner can say the weighted average cost of capital. Whatever it is, we don't need to find out what it is that we need to do, what it is that we need to consider. It is only when we are doing financial management and then the financing of the project changes from equity finance to equity and debt, and the gearing of the company is changing. That is where the examiner can give us the cost of equity, and in that way we need to calculate the equity beta and come and calculate the new weighted average cost of capital for the project. But we wouldn't use any of this technically if we are using the basic NPV schedule in relation to that. So now that we have this, let's get a total present value. So what will be our total present value? 2547 plus 1907 plus 2203 plus 1985 minus 519, and that will be 8123. Hey, is it plus or minus? Let's confirm my last punched item. Yeah, minus 519. I'm getting 8123. So that is the total MPV, 8123. But remember the initial, okay, yeah, thank you, Henry. So the initial cost has to be brought, initial cost of the project, which is the 6,500, will be brought, so that we can now get the net present value. Does it make sense? So let's take it out, minus 6,500, and that will be 1623. 1623. So it's a positive MPV. So we say that, hooray, we will accept the project and go ahead with it. Does it make sense? So that is the answer to the question. And this is for 14 marks. This is for 14 marks. Remember that we mentioned that a couple of this, how do we call it? The research cost they incurred 1.5 million. We said it's a sunk cost, so we don't consider it when we are doing our workings in relation to that. So Lila is saying, I'm asking the cost you will in terms by 1, and the other amount you will times by the applicable rate. I'm trying to get a concept that you are trying to say. Are you saying the initial cost should be multiplied by 1? Yes, that is why the initial cost, I didn't bring here a 0 in my schedule. I'm just deducting it down here in relation to that. Right, so that is the answer to the question for 14 marks. Very simple, sweet, straight to the point. If there are any things I want you to pick up in this question, is number 1, how we move from real rates to nominal rates. Sorry, how we move from real to nominal to real. Very important. You must know that very well in relation to that. Then how we consider a couple of items that are relevant and other items that are irrelevant. And that is what you need to understand in relation to that. You remember that the fixed overheads allocated, we did not consider that. Why? Because it is an allocated overhead, and we incur that cost whether we go ahead with a project or we do not go ahead with a project. So that is not going to be considered in making the decision of what has to be included in the cost. Then you do your workings for sales. Now, the good news here, like I said earlier, was that we are not supposed to bring in the issue in relation to capital allowance. So that is a relief. It's a huge relief that we have got, we were given in the question. If the examiner wants us to look at the capital allowance, he would have given us the depreciation, or we would have still calculated the depreciation on a straight line basis, because if the residual value is, we got a residual value to be 325, so the total depreciation over the 4 years will be 6,500 minus 325. So the total depreciation will be 16175. We divide it by 4, and that will be 1544. So that will be the depreciation. So we're going to be putting the tax rate on this figure, and that will be the capital allowance allocated for every year if we are going with a straight line basis. And in the year of disposal, we're going to take into consideration the proceeds that is coming in relation to the disposal of the assets. So this is what you need to understand about this question. Very simple, sweet, straight to the point. 14 marks per the requirements of the question that we need to look out for, and that is it about that. So let me know, do you have any questions for me real quick? So Lila Adam said, nice question with variable and fixed. Thanks. Okay, you are welcome. He said, yes, sir. That's what I'm asking. All right, I've already replied to that. Okay, so that is it about this question. Any other questions for me real quick? And I'll be signing off around here today on this one. Like I said, this is something that is examinable in MA and is also examinable in FR. As a matter of fact, this is an MA past question that we picked it from, but the principles and the rules apply when it comes to dealing with either F9 financial management or F2 management accounting in relation to that. So that is what you need to understand. Thank you very much for joining the live stream today. It's always a pleasure coming your way to share with you what it is that you need to do in order for you to understand and be able to take your career to the next level. Remember that Katachie Hayford said, I always don't get the feed on time, please. If you don't get a feed on time, number one, probably you've not subscribed to our channel. Okay, you are watching from Facebook, so you can like and follow my page so that immediately the meeting is scheduled, a notification will be sent to you. Then when the live stream starts also, a notification will be sent to you. So if you'll be watching on Facebook, then you can like my Facebook page and follow the page so that once the meeting is scheduled, notification will be sent to you. And when you are following, indicates that notification should be sent to you. So when you click on the bell icon there, once I schedule a live meeting or a live discussion, you'll be able to get a feed and join in relation to that. So that is it about that. Then also remember to follow me on Instagram at Nhyira Premium. The question is on my Instagram page. You can get access to the question on the page and then take time to also go through it in relation to that. So thank you very much for joining the live stream today. It's always a pleasure coming your way. I'll see you same time tomorrow. But before then, let me look at a question from Henry. Can you also bring the initial investment in year 0 and negate it? Yeah, why not? It's possible. So I didn't schedule that in my NPV Shadow, but it could bring that up. Okay? It could bring that up here so that it becomes 0, 1, 2, 3, 4, 5. Yeah, you can bring that up there. If you bring it up there, no P, you'll be able to get your answer as well in relation to that. And then if you do only the 1 to 5 and come and subtract it like this also is the same thing. So whichever way that helps you to understand, you should go for it in that case. So that is true, and you can stick with that in relation to that. Right, so for those of you who are writing Principle of Taxation and Advanced Taxation, our revised Advanced Taxation book is out now. It's 120 Ghana cedis, so you can call or WhatsApp 050-114-9296. You see the number on your screen as well as scrolling below the screen, and you can call or WhatsApp that number and you'll be able to get access to the book so that you can use it to be able to prepare well for your examination. This is a revised book based on the Act 2007, based on the new regulations, and strictly based on the ICAG syllabus. My book on taxation, and by extension, all my other books are strictly based on the ICAG syllabus to help you to focus on just the things you need in order for you to pass your ICAG examination in relation to that. So if it is something that you are interested in, you can call or WhatsApp the number and we will be able to reach out, arrange your delivery, and be able to get what it is you need to get in relation to that. All right. So thank you very much for joining the live stream. It's always a pleasure coming your way. I'll catch you same time tomorrow, 4:30 p.m. GMT, as we continue with our discussion. Remember to subscribe to the channel if you have not subscribed to the channel, and click on the bell notification icon. That way, when I go live, YouTube will be able to send you the notification, so you'll be able to join the live stream. Thank you very much, Augustine A. Boatin. It's been a long time I heard from you. I hope you are doing well, and New York City is treating you better now. I hope so. But hey, take care of yourself, and I'll catch you same time tomorrow. Till we meet tomorrow, stay blessed and stay safe. Bye-bye.